Hello, everyone. Welcome to this week's What the Frig Friday. We're doing a little bit of a mortgage minute. So I've got Tanya Steenbeek. Did I say it right?
You said it perfect.
Yay! Awesome. So we're going to be touching base a little bit on some of the mortgage stuff that's been changing and what she has been seeing in the market because as much as, real estate has its different things, we are very much interconnected. So I really wanted to bring someone in who is a professional in the mortgage space and really help our viewers know what's going on and how we can be better prepared for the changes that are coming up in the market. So welcome, Tanya. Thank you for joining us.
Thanks for having me, Tara. I'm super excited to be here.
Yay, yay, me too. So there has been a lot of changes, and I know I've been talking it a lot in my sphere and on my newsletter and stuff. But can you explain from the mortgage perspective what that looks like and some of these changes that are being brought up from December and January of this year?
Absolutely. So one thing many people have noticed is that affordability is tough, right? Getting into the housing market, coming up with the down payment, being able to afford the actual payments based on current interest rates. So what the government has done is they've taken a look and said, how do we make purchasing your home more affordable? And they've done that in a couple of different ways. Some announcements happened in December, some started in January of this year. But it's always confusing for the consumer because what is actually going to be applicable to me? How does that affect me? So I'll start with the first-time home buyers. So with first-time home buyers, some of the changes that have happened is that there used to be a maximum 25-year amortization. So that's the period of time to pay your mortgage off in full. And so on a 25-year amortization, your payment would be higher than that if you had an extended amortization out to 30 years. So that is one of the changes that happened is we can now, for first-time home buyers, use a 30-year amortization. So that's great news. So again, number one, from qualifying, makes your payment lower so you qualify for more. Second, for their personal budget, a 30-year amortization gives them a lower payment. So that's awesome. Some people would say, but that's not great because now I'm going to be paying more interest because it's a 30-year amortization. Most mortgages have the ability to increase their monthly or biweekly payment and or make lump sum payments against their mortgage. So though you choose a 30-year amortization to start, for affordability, getting into your first home, getting comfortable, the moment your finances allow it, you can increase those payments or make lump sums along the way. So that's a positive change.
Is it something that you can work through what their affordability is? Like, say we do this for 1 year, after year two, we can increase it. Because I do know that that is some of the conversations that I've had too with some clients in regards to, going to that 30 year, but then bumping up your payment so that you,
Right.
pay down it faster. Is that something that they can work through with you in regards to pay down payments, interest
Yeah.
paid out? Yeah.
Absolutely. And we stay in touch with our clients. So just because we do your mortgage today, we advance it today, you take possession of your home. You will hear from us continually because we want to check in, make sure things are going well, have things changed? Have your finances changed? Have you gotten a position where you're paid a higher salary and you can afford more? So yeah, we can do that. So when we do the original pre-approval or the approval, if we have I'm going to call it live deal. So you've purchased your home from Terra and now we have the mortgage in place. The nice thing is we're going to say this is what the banks say you can afford. That's an important component. But what you can personally afford in your personal budget, that's another piece of it. So we have that discussion on day one, and then we have the conversation around a monthly payment, a biweekly accelerated payment, how that helps. If you're not ready to go there yet, we can make those changes down the road. I have an app I give clients so that they can play with. I think it's super exciting. Now, not everybody finds mortgages as exciting as I do, but we provide an app as well so they can play with it and say, if I increased it by 5%, 10%, $50, $100, what does that mean? How much interest can I save? What will my payment look like? So yeah, absolutely. A year down the road, 6 months down the road, 2 years, 10 years, we absolutely are here to run those numbers with them and see what's affordable based on their current situation.
That's awesome. And I do get people that come up to me too and they're like, "What, I can afford this much money." And I'm like, "Well, that's really great." So when you talk to your mortgage broker, that's the conversation that you have because I do think that some people get a little bit lines confused of what roles, which roles, but I think that that app is going to like definitely an added bonus because people do come up to me and been like, I can afford X payment. Well, that's really great. So now we got to reverse engineer that with your
Right.
mortgage broker so that we can look for the appropriate houses. So I think that that's
Yeah.
really awesome.
Yeah, it's been really nice. And then the other thing, the government, we've had an implementation. So many people are familiar with first-time home buyers being able to withdraw money from their RRSPs with no tax implications if they're using it for the down payment of their home. So that's been in place. Previously, you could pull out $35,000 for that. It's now $60,000. So great news. How that one works, of course, is you pay yourself back. You pay your RRSP back over a 15-year period. So it's a great way to save on taxes when you purchase it, and then a great way to have your down payment saved, but you will have to pay yourself back over the 15-year period. But they've added one more, I'm going to say level, which is called a first home savings account. So that's where you can do 8,000 a year up to a maximum of 40,000 in a lifetime. You still get your tax receipt, so it takes off for your tax time, which is this is a great topic for today because we're almost at the end of February, right? But
Yeah.
so then for your home savings account, you can make that purchase. You get the tax receipt just like your RSP, which helps reduce how much money you pay or increase how much you get back. And then when you take that money out for your down payment of your first home, you can do it with no tax implications and you don't have to pay it back. So it's even better. It's kind of like the RSP on steroids. So it's just a really nice, and you can combine the two. So those are some of the changes. People always say, first time home buyers, what's special for me? And those are
Right.
the
Yeah.
special things, your home savings account, your RSP, your extended amortization.
So then in regards to that RRSP piece, I know with some clients, they put the money in the RRSPs and expecting to be able to pull it out, but in a regular RRSP, they have to hold it there for 90 days. Is that correct?
Yes.
Like it has to be held in your RSP for 90 days. Is that the same for that first time, the new incentive? Is
It's
that
not.
this?
So the RRSP has to be held there for that period of time before you can withdraw under the Homebuyers program. The
Right.
FHSA, or First Home Savings Account, it has no time limit. So if it was in there a week, then you could still pull it out. So it's a really great way to go. So for example, your client comes and says, I wasn't planning on buying a house for 6 months, but I love this house, Tara. Show it to me. And they want to put an offer on it. And they have, say, 5,000, 6,000, 8,000 in their savings account. It makes perfect sense for them to put it into an FHSA, get the tax break, and still have their down payment saved. So we have those, though I'm not a financial planner, I don't
Yes.
give financial planning advice.
Disclose,
Those are the
disclose,
things.
disclose. Yes.
That's right. Those are the things that I will say you should go talk to your financial planner, see if they can look after this for you. Because if we can find a way to help the clients either A, save more, or
Hmm.
B, turn their 8,000 into say 9,000 if they get a tax,
Yeah.
they get a tax refund or something, then
Yeah.
we're always looking for those opportunities for our clients also.
Yeah, because I was again chatting with a different client and he was like, "Yeah, I got the money in a GIC. I was talking with my financial advisor and they were just going to break it and then just put it through the new program and then pull it out right away." And I was like, "They don't have a 90-day hold?" And he's like, "No." And I was like, "Wow, that should be marketed more
Yeah.
because the 90-day hold on the RSP, I think is a crucial thing, but I think it's one that is not told as much because they're like, "Oh, I just got the money in my RSP and then I'll just pull it out." And then, well, no, that you got to wait now 90 days.
Yes.
So
Yeah.
like you
Yeah.
can't use it right away. So it's definitely one of those things that in that vetting process with the mortgage broker that needs to be looked at is how long it's been in there because it's a communication piece that I think is missed a little bit on that timeline.
It could be. And as part of the pre-approval process, or part of our pre-approval process, is we actually ask for confirmation of down payment at the pre-approval. So you need to provide a 90-day history of where your down payment is. So if it's in a GIC, an RRSP, a bank account, if there was any deposits to that account, whichever one it is, within that 90 days, we then have a conversation with the client because we have to identify source of funds. And this is kind of going down that rabbit hole, but this is where the paperwork can get messy. But if it was there for less than 90 days and it came from a GIC, then we need a 90-day history on the GIC. Or if it
Mhm.
came from a different bank account, we have but there is always that pre-look at that 90 days to see if something was deposited within that period of time that we have to address now.
Yeah. And another comment too that I have with clients often is, did you submit your documents when you got your pre-approval? Because a lot of people just do the little app on the thing and they think they're good and they're like, yeah, no,
Yes.
I've got it. But there's like the pre-qualification and then there's a pre-approval, and it's definitely, a process to get that full pre-approval so that we know we're educated in our shopping,
It
right?
is different. Yeah. So pre-qual, and I have it on my app also. So a pre-qualification is you, the client, input the data. So when I ask you for your income, you're going to tell me what you think your income is. So you might say, well, I make 120,000 a year. And then when I get the documents, I know what lenders are looking for. So if you're getting overtime, bonuses, live out allowance, some of those incomes like live out allowance can't be used. So overtime and bonuses, if I'm going to utilize that, I need a 2-year average. And so a lot of times those pre-qualifications aren't that the clients aren't being truthful, but they're putting what they know into it. So coming for a pre-approval is we get the documents up front so I can have the conversation saying, totally understand, but for the last 3 months you're making 120,000 a year, but last year you made 40, your base salary is 80. And so that's where that piece of it, you're right. So that's why asking that question of your clients, did you submit documents? No, just went
Yeah.
online. Totally different.
Yeah, for sure. And even too, if you are self-employed, there's different things that they can, different line items that they can subtract off your deductions and stuff like that. So it's super important to make sure that you have, a fully vetted conversation with your mortgage professional
Right.
so that they really can go through all the line items like you were
Mhm.
stating. Because, as a realtor, when you go to buy a home too, there's things that they can add back or whatever, however
Right.
your part works that and you need to speak to someone who knows what they're doing so that you can really be educated, especially in this market.
Well, you want to have a, I mean, you would speak better to this, but as we're going into the spring market, things are going to get, I find them busy today. So they're going to get even busier. So when you're putting your condition to financing in there, the seller's realtor is wanting to know that you're pre-approved. They want to know that you have that in place. And I'm asked for pre-approval letters more than ever now because they just want to make sure they're accepting the offer of the individual who's done the work already.
Yeah, I'm seeing it. Some won't even take them. Like I was in multiple offers with 14, with 7, with 4, and they won't even look at them without a pre-approval letter. Like
Yeah.
if you haven't done your diligence and can get a letter, then they're going to move on to the other ones because they've got many more to go through. So,
Yeah,
yeah.
no, 100%. Mm-hmm.
Yeah, for sure. So what are some other things then? So we've talked about the first time home buyers changes. I know there was quite a few changes coming in those last 2 months and then moving forward. So what are the other things that you're seeing?
Yeah, so we spoke specifically about first-time home buyers. So if you're a repeat buyer, someone who's already owned a home, they're also trying to make building a new home more affordable. So if you're building a new home, then we can also get a 30-year amortization for those clients. So if it's an insurable mortgage, and the client wants to extend to the 30 years, they can do so as a repeat home buyer. So that's been a nice one. And I think that's really basically to try to attract more people to the builds, get a little bit more, productivity going. Spec homes would also be included in that. So if it's a new build, even if it's 90% complete and you put your offer in, that would be included. So that's another nice change. Again, that's an affordability piece of it.
Right. You mentioned insurable mortgage. Can you just touch base on that? I know the language, but I just want to make sure the viewers do as well. So what does that mean?
So if you're or insured, so there's two
Yes.
types of mortgages. It's buying a house with less than 20% down. If you buy a house with less than 20% down, you've probably heard of like CMHC, Sagen, CGI. They're called insurers. They're basically people who underwrite the mortgage. So in Canada, you can buy a home with less than 20%, but if you have less than 20%, you're going to pay a CMHC, Sagen, CGI premium. So you'll pay an insurer premium to underwrite that mortgage. So if that's the type of mortgage it is, we can extend the amortization out. So that's what like an insured mortgage is. Conventional, basically you're putting 20% or more down. You no longer have to pay that premium. For most
Yeah.
files, there's
Yes.
special programs like New to Canada and a few different ones that even if you're putting more than the 20% down, it has to be underwritten by one of the insurers and there might be a premium on there. But
Yeah.
just generally speaking, if you have less than 20% down, you're going to pay a premium. If you have 20% or more, generally speaking, you don't.
Yeah.
I'm going to just veer off into rates for 1 second, just
Yeah.
because this brings it right into there. The other thing is people say to me all the time, what's your best interest rate? So
Mm,
interest rates
yes.
also depend on the type of mortgage. So if you're buying a house with less than 20% down, people think, well, the more I put down, the better my rate should be. That's not always the case. So when you're putting less than 20% down, you're paying that insurer premium, you're actually getting the best interest rates. Those are the lowest rates in the market. And people say, well, why would that be? Well, it's because the lender is taking less risk, right? Because it's underwritten by an insurer. If that mortgage was written off, defaulted on, then they have the support of the insurer. Therefore, their
Yes.
risk is less. So that's an interesting. And then when you get to 20% down payment, your interest rate's a little bit higher than the less than 20. And then we
Yes.
have some lenders, when you get to 35% down payment or equity, then the rates go down again because there's
Yeah.
a larger a barrier in case something
Yes.
happened. So if you reach out to your mortgage professional and you say, what's my best interest rate? So if it was me, I would go back and say, I need to ask you a couple questions first. But
Yes.
yeah, so you're paying the premium, but you're getting a little bit lower interest rate. So I just wanted to kind of mention that
Yeah.
because it goes into that piece of conversation.
Oh, for sure. And I think too, part of it to understand is that you're insuring the bank. Like it's a product that protects the bank. It doesn't protect you. So it's the banks having less risk because
Yeah,
that insurance product, if you do default, protects the bank from, losing out on that money or whatever, however it works on their back end.
exactly.
But
And
I
that's
think
why
that
that
that's an important
terminology
piece.
is confusing when you said insurer, insurable. So, because there's different types of insurance, and you're right, it's very confusing. So, when you're paying
Yeah.
that insurance or that premium, that insurer premium, it's protecting the bank. The other types of insurance we talk about is then homeowners insurance. So, when you get a
Yes.
house, you have to have homeowners insurance, and that's you protecting in case of fire, flood, those types of things. So, that is a different type of insurance. And then you have
Yes.
mortgage, life, and disability insurance. So there's
Exactly.
all these insurances that I think they get very confusing for the consumer. So thanks for bringing that up because that's
Yes.
exactly how that one works. It's protecting the bank.
Yeah, it protects the bank. Yes. And it is a fee that you see like right on your mortgage statement. And I've had people like, "What? What is this fee?" I've actually had one person who walked out because they're like, "I didn't realize the fee was so much. I'll wait to save." And I was like, "Oh, like
So
okay."
that's unfortunate. They're getting to the point of there before they
Yes.
realize there's a premium because
Yes.
that's absolutely part of the conversation for sure.
I agree for sure. So this is why making sure that you work with a mortgage broker who, explains the process because buying a house, there's lots of moving parts, right? From
That's
the real
right.
estate perspective, from the mortgage perspective, from the inspection perspective, or whatever your conditions are. There's just so many moving parts that it's important to work with someone who can, work through it with you and really help you understand and educate so that you can make the best and informed decision in
Yeah.
regards to what works for you and your finances and the vision you see for your life. So
Mhm.
it's
And
super
having a good, I
important.
call it a deal team, but I think
Yeah.
having a good team, like a team of partners, like so having Tara as a trusted realtor who has a lot of experience and is going to guide you through, or having Tanya as a mortgage broker you trust, having a good lawyer. The communication between all those parties is key to make sure that the process goes very smoothly.
Yeah.
So that's always a nice piece of the business when you do have great partners you work with.
Absolutely. And it
Mhm.
helps us too, right? So that's great. But you did touch on a little bit about interest rates then as well. So I do get calls as well. What do you think I should do? Should I do fixed or variable? And what is that? Can you explain a little bit about what those look like and how you have those conversations with your clients or where those interest rates come from?
Yeah. So there's two types of interest rates, and this is where it gets very confusing for the consumer. So as many people know, Bank of Canada, they make an announcement. And so before their announcement, there's a lot of media around it. Bank of Canada is making an announcement, inflation's going down, interest rates should go down. So variable rate, it is impacted by the Bank of Canada's announcements. So when the overnight lending rate goes down, then generally all the banks follow and their prime lending rate goes down. This affects clients who are variable rate holders or home equity line of credit holders only. If you have a fixed rate mortgage, this doesn't affect you in any way. Okay. So, first, there's that differentiation. Fixed rates, they can be any term, 1, 2, 3, 4, 5 year terms, and they are driven by the government bond rates. So, if you hear in the news the bond rates are going up, then generally you're just going to see the fixed rates follow. Bond rates are going down, you're generally going to see the fixed rates follow. That's the difference between fixed and variable, because I will have clients that will have a pre-approval and they'll say, I heard the announcement tomorrow is going to be 0.25% less. Should we hold off doing a pre-approval? Definitely not, because number one, when we do pre-approvals, we rate hold for 120 days. And if rates go down, we're very active and we float those rates down. That's the first piece of it. And secondly, it depends if you've chosen fixed or variable based on your risk tolerance, your financial plans, where you're at in your life. And I think that was part of your question is, as a consumer, how do I choose between fixed and variable? And
Hmm.
every individual is different. So if you and I had a conversation and it made sense that variable is more in line for you, I might be talking to, Amy Smith, and it would be a fixed for sure. So some of the questions we talk about is how long you're going to be in your home, or I guess expect to be in your home, because plans change. The other
Yes.
piece of it is around risk. Like, if you did have a payment fluctuate, obviously, if rates go down or payments go down, everyone is happy. But how would you react to what we've had the last couple of years, which is interest rate increases? So that variable rate went up significantly over that period of
Mhm.
time. And so people's or who were in payments, variable rate payments that were adjusting and increasing, their
Yeah.
payments were going up significantly. And that was impacting their ability to live life on a month to month basis. Those who had variable rate mortgages with a static payment, meaning the payment didn't change, but the amortization did, some of those people had a 25-year amortization and now they have a 90-year amortization. Well, you can't have a 90-year amortization. So when the mortgage comes up for renewal, there's options. It's make lump sum payments. And so that's the conversation we have is, obviously best world, if rates go down, everybody likes it. But yeah,
Yeah.
so it's different for everyone based on I think their risk thresholds, how
Yeah.
much they can afford to have variances in their payments. And really at the end of the day, if you choose a fixed, you have to be saying, I'm comfortable with this fixed rate based on everything I know today, because hindsight's 2020. And if rates go down, yes, we're going to go, oh, shoot, I should have taken this other one. But if rates go up, you're like, oh, thank goodness. And so it's just making the best decision in the moment for you.
Yeah. And another thing too, it's about term of your mortgage as well, right? Like, what does that look like? Maybe we just do it for this window, or like, like as much as it's amortized out, there's still terms that you can put
Yeah,
into to
100%. Like you can go a 1 year, a 2 year, a 3 year, a 4 year, a 5 year term. Generally speaking, and not always the rule, the shorter the term, the higher the rate, right? So if you want to take a 1 year term, it's generally a higher interest rate than a 5 year. Right now, the 3 years and the 5 years are actually fairly comparable. So that's the conversation with the clients too. And some people are going into 5 years still. Others are saying never go into a 5 year right now because rates are crazy. Rates aren't crazy. Rates are very average right now. It's just that we got used to those really low rates for that period of time. Some people call them the COVID rates, right? So there was a period of time where getting fixed rates under 2%. So if you purchased a home at 1.89%, and I did many mortgages at 1.89%, and now it's coming up for renewal at say 4.2, 4.5%, for sure that's going to hurt and you're going to feel that. But for people who used to pay 10%, 8%, 7%, and in my lifetime, I'm going to give myself away, but in my lifetime, I think my first mortgage was at 7. And at the time, my parents said, oh, you're lucky. And so and my oldest son now, his first mortgage is also just under 5% because he purchased just in the last 12 months. Whereas if he would have purchased 3 years ago, as many did, this would feel
yeah.
unbelievable. Yeah.
Yeah, no, for sure. And I love how you keep saying it's about risk because it is all about a tolerance level. Even when you purchase a home and you're like, do I want something turnkey or can I do these repairs? Or when you look at an inspection, like, what is your tolerance level? Are you prepared to be able to, you know, work through those things? So it really is very an individual process for each person because each person's going to be seeing, you know,
Mhm.
their risk levels or what they're comfortable with change on situation to situation. So,
Absolutely. Yeah, it's true. It's in every aspect of your life. It's, buying your home, it's financing your home, it's, making a decision on schools, daycares, the whole everything. It kind of
yeah,
comes down to it in everybody's unique situation. Yeah.
yeah, for sure. Yeah, well, that's exciting. So was there any other changes or any other things that
Yeah,
you've
so one big one I'll
noticed?
mention, and then I know we have to wrap it up because we're taking everybody's, very valuable time. But on the executive homes or the homes that are over a million,
Hmm.
so in the past, if you purchased a home that was 1 million or more, you had to put 20% down. That was a requirement. Whereas now the government there has been some rule changes that you could go up to 1.5 million now. So if you bought a 1.5 million dollar home, last year, you would have to put 20% down, which is $300,000. But now we can go up to 1.5 on the minimum requirements of an insured, which is less than 20% down mortgage. So on any mortgage, the first 500,000, you can put 5% down. If you buy a house for 500 or more, then it's 5% on the first 500, 10% above that.
Okay.
Obviously, if you're going to buy a house, just call me and I can run through because that's a little bit confusing. But the long and the short of it is you could now buy a $1.5 million home with a $125,000 down payment versus a $300,000 down payment.
Oh, yeah.
So that comes into affordability too, because the larger your mortgage, the bigger your payment. But for a lot of people, they can afford the payment, but it's almost impossible to save the down payment when you're paying rent and everything else. It's hard to put the cash aside for it. So that's been well, I guess it's arguably a positive move. I think it's positive because if you can still put 20% down, you do it.
Yeah.
If you can afford the payment with less down payment. So that's been a big one. And that's nice for those people wanting to get in over the $1 million mark. And for realtors trying to sell homes over $1 million, it makes it more affordable for their clients to buy now. So it kind of
Yeah.
opens up that space a bit more.
Yeah, and I think too at that price point as well, like I'm seeing a lot more of multi-generational homes and things like that. So the income's not so much an issue because you have multiple families or, those types of things helping when you get to that price point. So it is a down payment versus the
And in
mortgage.
a future podcast, we may want to touch on that a little bit on how you can buy multi-generational homes, like with legal basement suites or legal laneway homes.
Yeah.
That how if you're buying a home like that, that can actually help you debt service your home by using the rent on that. So there's a lot of things that we can do because
Yeah.
multi-generational living is becoming more and more, I'm going to say, the norm because
Hmm.
of the cost of everything. Well, for the
Yeah.
cost of everything, but also I think that people are getting back maybe to their roots as well and thinking that, from a childcare perspective, a sharing of cost perspective, it makes sense. But yeah, we can absolutely touch on that on another time as well and how
I
that
would
looks.
love it. I would love it. I love it. That's so great. Yes. Well, thank you so much for joining us today. I'm hoping that everybody has taken some nuggets and we'll put your contact information as well in the notes and stuff so that they can reach out. And yeah,
Yeah.
thank you so much for joining.
Thanks for having me. It was fun.
Yes. Yay. Okay, we'll talk to you again.
Thanks.
Thank you so much for watching. I hope you found today's insights helpful. And if you're interested in learning more and ready to take the next steps on your real estate journey, don't hesitate to reach out. Us at Masterful Moves Realty Group are ready to serve you. If it's 4 days, 4 months, or 4 years, it's never too early to connect. And if they found this information useful, don't forget to share it with someone who might find this a benefit. I thought it was really great to have Tanya on and speak of the mortgage information. So I hope you're having a great day. Don't forget to like, share, and comment below. Talk to you soon.